dream broke, but it's clear now. No handouts, had to get down. Now what they fear now. No money, millionaire, we here now. Got scars, but I wear that crown. Turn pain to a real account. No money, no excuses, no limits.
Welcome back to the No Money Millionaire podcast. I'm Dave Webb, your No Money Millionaire, and this is where we teach people how to build wealth without using any of their own cash. Today's episode is about true passive income. Not flipping, not rehabbing, not taking on a second job disguised as real estate. We're talking scalable wealth, tax strategy, and cash flow that doesn't depend on you showing up. Today's episode is about true passive income, and the guy I brought on today knows that game at the highest level. Lane Kawaoka is a former engineer who now owns more than 10,000 rental units worth over $2.1 billion. He focuses on passive investing, helping high-income earners escape the W-2 treadmill, and using the tax code the way wealthy people actually use it. He's also the author of the new book, The Wealth Elevator. Lane, good to have you on, man. Thanks for coming to the show.
Yeah, thanks for having me, David. Aloha, everybody.
Let's go back for a minute. You had the salary, the career path, and the do everything right life. When did it first hit you that the W-2 wasn't going to make you wealthy?
Well, I knew it was going to work, right? And I knew like investing in the 401k, buying a house to live in, that was kind of where I started off with. Out of college, I had a decent paying job. Engineers, aren't, they don't make multiple six figures, especially right out of college. But I had some good saving skills, and I was able to put away, a few hundred, maybe like 30, 40 grand of savings per year. I saved up a few years to go buy a house to live in, like we're all supposedly supposed to do. And because I was traveling all over for work and only home on Saturdays, I just kind of decided on a whim to rent it out. And that was kind of where this, kind of got this taste of cash flow, of entrepreneurship. And then shortly thereafter, it was like, wow, if I just kind of rinse, wash, repeat, do this a few more times, I'd be able to kind of, get away from the day job at some point.
Sure. So you bought your first deal, you saw the cash flow, that changed everything. But most people jump into flipping or the BRRRR, try to DIY their way to freedom. You skipped all of that, went straight into passive rentals. Why?
Yeah, I mean, I know this is the no money show, but I had some money, right? I mean, 20% down payments is kind of the standard investment path. At that time I was living in Seattle, and for a lot of people, buying properties in your local area, especially if you live in California, Hawaii, these primary markets is just not going to work. The rent to value ratios aren't going to be working in your favor. So I started to buy properties in places like Birmingham, Atlanta, Indianapolis, where you could buy a house for $100,000. Now that may seem pretty crazy to some people, but that's actually how most of the lower middle class America lives these days. And with a 20% down payment, you're in it for, $20,000-$30,000, including some reserves there. So I know a lot of people, I don't really teach any of the active strategies like the BRRRR, as you're mentioning. I personally think it's pretty high risk. I mean, there's a lot of programs out there that teach it that, you pay money to learn that. I would not suggest that. I would say every penny you need, you got now. Especially if you don't have very much money, needs to go to that down payment.
Yeah. I have apartments, about 100 apartments, but the last ones I just bought, you mentioned the Midwest and, Center America. I just did a package deal of 9 houses that I bought for $950,000. So I was able to get them all around 100 and something thousand a home. And they were a package deal. I had to buy all 9 together. And so this is the first, I've never flipped anything. I've held on to everything that I've done. Well, when I was younger, when I first started, I sold my first or second home, but these 9 are going to be the first ones I actually turn, just because I saw such a demand in that market. But I was just bringing it up to talk about, there's still homes for $100,000. I just did a package of 9 of them for $100,000. So a lot of people think they're investors when they're really just self-employed inside a property. What made you commit early to scale instead of just the hustle?
Yeah, I mean, you need to, right? Like for $100,000 house that rents for $1,000 a month, you're gonna pay the property manager 10%, which, by the way, I think you should always have a property manager. You shouldn't try to do it yourself, for obvious reasons. With your time should be spent making money, right? For me, it was at my engineering job, or somebody may have a job that's very busy. Maybe spend the time going for a promotion, right? Like a career path.
Yeah.
And then also the legal liability reasons, right? But property manager kind of follows the rules. They know what they're doing. They're professional about it. And you have their insurance policy too, between you two. But, and then you have the repairs, the maintenance, that's another 10% there. I mean, on my website, I got this analyzer tool. Basically, the meat of it is, you have all these expenses that kind of chip away, 10% here, 10% here, and then you have the capex that comes up every blue moon, but it comes up. You need to allocate for it. At the end of the day, for a good rental property, you may only cash flow $100, couple $100 a month. And this is where I got to in 2015. I had 11 of these little rental properties, and then I started to realize, back then, say cashing $200 to $300 per property, $2 to $3 grand per month, right? Not bad, right? Not complaining about that, but
sure.
Most of my clients today are looking for $10,000, $20,000 of passive income a month. So you're going to need to increase that number of rental properties from 11 to like 30 or 40 of those things. And it just quickly becomes unsustainable and a headache managing that many properties, because with 11 properties, I had maybe an eviction or two every single month, some kind of big catastrophe that happened every quarter. Not a big deal because the property manager takes care of it, but still, I mean, that's kind of to answer your question. That's the reason why you need to kind of scale up to more bigger assets. However, if the person is listening is not a credit investor, under $500,000, maybe even under $1 million net worth, stick to the single families and build your net worth that way first.
Yeah. I still manage mine right now. I've gotten to the point where now it's driving me crazy. I started, I got my first one and I was just doing everything, and I just accumulated like 20 here and 10 and 10 and 10. And I renovate them, I manage them, but I'm trying to get to like scale, like you said. I'm looking to get to larger 100, 200 unit properties where they have an on-site manager, and I can just start now focusing just working with those. And so how did it go? So you just mentioned 11 to 10,000 plus units. Tell me a little bit about the gap in there, and are they all throughout the United States, or are you kind of focused in a general area?
Yeah, I mean, everybody's working with a different set of tools, right? Like you were doing more renovations. I wasn't, right? Like I was kind of buying them turnkey. It was pretty passive. And I tell people look at what you do for work, or like, what is your hourly rate, right? If you don't make $300, $400 per hour at a professional job, then yeah, you may want to property manage your properties, or especially in the beginning, right? Beginning stages. But yeah, 2015 had those 11 rental properties, started to kind of see the writing on the wall. More importantly, started to interact with other purely passive accredited investors, and started to realize, yeah, they were all kind of trading in their little rental properties for bigger investments. But, they wanted to diversify, right, geographically, and then all their different asset classes, even outside of real estate, right, private equity, venture capital. And the only way to do that is to get away from being the operator, right? So, when you're the landlord, you're the guy, right? You're also the guy who's going to get sued if anything happens. But when you're a passive investor or LP in a lot of these syndications, you're just a passive investor. Sure. That said, in my humble opinion, I don't think you should mess around with these until you're an accredited investor, right? But once you are, I think it makes a lot of sense, because now you're able to diversify and go in whatever market, when I had 11 properties, I was pretty diversified in 3 different markets: Birmingham, Atlanta, Indianapolis. Had another in Pennsylvania. So if, there's a nuclear disaster in one, or Space Force pulls out of Alabama or something like that, then you're somewhat diversified. But, now we're talking about the ability to invest in anything. And I think the other big thing is the commercial assets really are stronger assets from a income and cash flow perspective than the little single family homes or anything under $5 million purchase price, because you're just competing with the masses out there. Masses meaning the mom and pop investors. So, for a variety of reasons, it's kind of smarter if you can to move up. But, again, since the audience listening is the no money guys, that's what comes later, right? Like that's in my book, The Wealth Elevator. I talk about the different stages of wealth building, which I did. The first floor is kind of the under $500,000 net worth level. That was buying little rental properties, more than likely buying properties outside your home area, focusing on cash flow where these things will pay for themselves. To do that, you need to find places where the rent to value ratios are 1% or higher. So you take the monthly rents divided by the purchase price, and they're looking for a ratio 1%. So if you're in California, not going to happen, guys. Not going to happen. Look elsewhere.
Yeah. I'm in Oklahoma, and one of the areas here in Oklahoma, to me, it's an anomaly. The rents are so high compared to what a purchase price would be. So I can buy a property out here, and it's for sale at $30,000-$40,000. And you can put just minor into it, maybe 20, maybe 30 tops, have about 60 all in, and that's renting for $1,000 to $1,200 a month. So to me, that ratio is just amazing. And I don't see that in a lot of areas. And so that's where a couple of my multifamilies are, but I started renovating them, and I was generating income from the renovations. I'd do the renovations myself. I'd GC it. I'd do whatever. And then I would, just pay myself a meager wage just from the renovation to create an income as I was building it up. But, and so now, like I said, I want to get to the scale like what you're talking about. I want to look and start having on-site management, because it becomes a nightmare after you have so many units and you're the guy that the phone call's coming to. It just becomes too much. And so I can understand completely what you're saying.
InvestorFi, the #1 lending source for first-time and early-stage investors. Just learned how to find your first deal? Let's get it funded. InvestorFi, the only no-money millionaire certified lender. Find us at InvestorFi Lending or visit our website at investorfilending.com. InvestorFi, turning new investors into trained professionals. What are you waiting for? Schedule your free review today.
So fast forward, 10,000 plus doors, 2.1 billion under management. People hear that and think high risk, high leverage, super aggressive. But you actually preach the opposite. It's predictable, it's cash flowing assets. So what do beginners get completely wrong about passive income?
Well, there's nothing passive about passive, right? Like you have to put in teams in place or property management teams. But I think this is where in my book, the second floor of the wealth elevator is when you get above $1 million net worth.
Okay.
And you transition to the third floor of the wealth elevator, sort of around $2.5–4 million net worth. The reason why that threshold is so, a bit of a range is it's different for everybody. That level is supposed to be when you're sort of financially independent. Of course, it's different for everybody. Cost of living in Oklahoma is going to be almost half of that is of a family of 4 in California.
Yeah, definitely.
So, but I think the whole point is like it's a net worth range, right? The better you are as an investor, the lower that needs to be, right? Like if you're an investor who can find great deals and get 10% on your money as cash flow, then you're going to need a lot less than the person who can barely knows what a T-bill is at 3%.
Right.
So, different strategies for where you're at is what I'm saying. And in my book, I kind of talk about that first floor of the wealth elevator where I went, bought 11 rental properties, and then transitioned as an accredited investor into, these more commercial assets, getting more scale, and then now kind of opening things up. When you get to this level, you're a little bit more economically resilient. You never want to lose money, but it's going to happen in investing. That's what investing is all about. At this point, you kind of maybe even get away from cash flowing investments. And I think that there's a misnomer in the allure of cash flow. When I first started, I was looking for cash flow because realistically, I was trying to leave my day job. I was just trying to replace that income. But if you look at high net worth families, as I started to meet them and started to run around more and more in their circles, they quite frankly don't really care about cash flow. They care about, the buffer, or how fat a deal is, and more the equity return at the end of the day. So I guess an example I'm saying is like, you take like an angel investment deal. Not saying that they're good investments, right? But these things aren't going to give you any cash flow, right? Yeah. But they could pop equity wise, or in the real estate world, a development. There's nothing built there. You got to build the damn thing first. Obviously, a lot of construction risks, etc. But you can sell it for a lot bigger equity pop. You're doing a lot more value add. Whereas, you're buying a stabilized 40-unit apartment complex, you've got 95% occupancy in there. Yeah, you're cash flowing, but realistically, there's not much of a value add elevate you can do to that thing. Yeah. Your equity multiple isn't going to be as high. So it's kind of funny. And initially, investors, they look for cash flow for two false reasons. First is they want to see the money come back into their wallet quicker because they have never done it before. This is all new to them, as it was for me, right? Alternative investing. Mm-hmm. And then the second reason is, probably their skeptic spouse is probably wanting them to see some type of quick feedback. But patient, sophisticated investors know that it takes time for these things, right? Like you can't just stick the bread in the oven and expect it to come out 5 minutes later. No, you gotta, for projects that make a big bump in value, you're gonna have to put in some hard work and value add. A lot of times, physical construction value add, and that's just not gonna be in a year or two, right? Sometimes it can be longer than that.
Yeah. I do most of mine have been equity plays. That's what I get in for the long haul. But I had an early partner in one of my first deals, and his whole thing was, and he was just like a passive investor. He didn't live in the same state. He wasn't hands-on, and he just always wanted to know, like, well, is there any money? What are we getting every month? What's coming every month? And I was like, it's not like that. It's not. You want to let it build, but it's an equity play. It's for the long-term vision. And some get it and some don't. And me, I did the same thing as you. I got into this to replace my W-2, and I was like, okay, I need so much cash flow every month to be able to surpass my W-2, to be able to, replace my W-2. And that was my goal when I started. That was what I was gauging it by. And then, I've learned, I've been doing this a long time now, and I've learned that the equity play is mostly what I'm looking at. But except those last 9 that I told you I just purchased, I have those now. And that just seemed, like I said, it's the first ones I've ever considered actually selling, but that was they're the first ones I'm going to put on the market and actually sell them. It just seemed the area was just hot. It seemed like there would be a big demand for the 9 individual homes. So, all right. So you've got the system. You've mentioned it already, the wealth elevator, 5 floors. So you've mentioned the first couple floors. You want to go, you want to talk about the other couple, how the graduation goes up?
Yeah, I mean, the third floor is when you get to probably like 4 to 10 million net worth, right? Most of my clients, they're perfectly fine staying in that category. Mm-hmm. To get above that 8-figure mark, number one, you can't just be a W-2 worker employee. You really need to run a business, or you need to have a generation or two, meaning your guys' kids, really to compound on what you're already doing. The level beyond that is kind of now you're you're taking it to another level. You have people on staff such as CPAs, accountants, investment directors, things like that. My job is to sort of help people bridge that gap between a full-on family office and a mom and pop investor or landlord, right? But I think for this audience, I would say focus on that first and second floor of the wealth elevator, right? That first floor is broken up into a few categories, as I detailed in my book. And we'll get into it right here, right? Like the first step is to buy a rental property, get into the game. Most people will buy that property in their local area so they can feel it, touch it, they feel comfortable with it. But like I said, that typically is not a good place to invest because a lot of y'all like to live in nice places like California, Hawaii, Washington, Seattle, Portland. We tend to stick to red states because we're the landlord and we want to have the landlord laws on our side. But then, that second layer is, and a lot of this is stuff I've lived myself. I started to buy in Seattle. My first units were in Seattle, Washington, a very blue state, very high price state where the rent to value ratios didn't make sense. And then I started to invest out of state, right? Remote investor, where now you're forced to trust other people, property managers, work, do due diligence remotely. If you were good at being a property management and cutting corners that way, then you're unable to do this. Like physically, you just can't. And then the next level, it kind of prepares you for that second floor of the wealth elevator where you're a passive investor and you've kind of given up control, right? But ideally given up control to more sophisticated investors who are better connected. And when you're buying commercial assets at some level, it's a lot about economies of scale. An operator with $200 million of assets is not going to hold very much respect and clout with brokers who control deals than somebody who's done, a few $1 billion of deals, right? Because the brokers, they want to give the deal to who can close.
Mm-hmm. Yeah, I'm gonna have to look to see because I want to go up some of those floors, and I'm at the point now where I know I have to relinquish control and put my systems in place. But I like that I came up doing it. And so I have an understanding. When I do start relinquishing it, now I'll be able to know what to expect and I'll be able to have something to gauge it by because I've been there hands-on. I came up learning from that, but I'm definitely trying to scale larger. I want to go up some of those floors that we just mentioned. And, but I felt I needed to learn that, or I wouldn't have known what I was doing as I did relinquish and I was talking to other people. So for myself, I thought it was good hands-on, but I've gotten to a point now where I have to relinquish it. I have a lot of the other people, the CPA and the attorney and stuff in place, but now I'm going to have to get some larger and some property management and stuff under my belt. So what floor do you find most people, or high income professionals stay at? You said right around the fourth floor. Is that where?
Yeah. They typically, if a guy starts investing in his 30s the right way, where they're investing alternative investments that give them good tax benefits, where they decrease their taxes to, a fraction of what the average other guy, their counterpart, is doing, they're typically able to get to $4 to $5 million, maybe a decade before or 2 decades before their counterparts, which means that they've maybe have another 2 or 3 decades to, kind of go for the overkill and get as far as they can. At that point, getting to 10 million isn't, out of reach. Mm-hmm. But, to build upon that, it's going to take another generation, right? But hey, that's really like you define your end game there, right? Like, again, most of my clients are perfectly fine with 5 million net worth. I think nothing's wrong with that. Most of the people in my group are first generation multimillionaires. But kind of going back to your situation, I actually would argue saying that, if I always look at people's circumstances and ask, like, what is your special ability? What is your secret sauce? Just hearing you talk about yourself here, it just seems like you're good rehabber. That's your thing. Why not keep doing it, right? No different than if a listener out there runs a successful engineering consulting business on the side, right? You have to ask yourself the quintessential question is, where is it that I create the most money per hour, right?
Sure.
It more than likely, unless you're doing it for 2 or 3 decades to run 100, 200 unit apartment complexes, it's probably, you've built up so much knowledge base that quite honestly doesn't really carry over to large commercial assets. I will say that.
Okay.
I would say stick with what got you here and where you are much better than everybody else. And I think you would attest to that, and use that to generate capital. So that means that's for people who are on a high level like yourself, but it also means people on a low level. Some people pay for these silly house flipping courses, and they've never done anything in life. I don't know if that's a good use of money, but there has to be something that you're good at that you make a good hourly rate at. Now, for a lot of my clients, unfortunately, it's them being a dentist or a doctor, right? And they don't like it.
Sure.
But whatever, too bad. Suck it up. That's how you're going to make money. Yeah. And investing is a capital intensive business. The hardest part is getting that first 100 grand or that pool of capital to start investing. So if you're a doctor, you have to just be doctor, right? And get that money. If you're a painter, damn it, paint. What is it your highest and best uses from an hourly perspective? And you may have to just do that.
Sure. Yeah. No, it makes sense. And coming from your experience, I'm sure it, holds a lot of weight. I'm not actually a guy who swings a hammer. I oversee everything. I really consider myself a project manager. I find the project, I bring the capital to the table, I get it rehabbed. I do answer the telephones, from the calls. But for myself, I just call myself really a project manager. I oversee the projects. I make sure that what I present or, I say that it's going to do, I just make sure that it does that. It performs, as it was proposed. And so I just see everything all the way through to completion before then I'll look at another project and try to do something there as well. So, so myself, I guess my talent is really just being the project manager, just seeing it all come together and make sure it's within budget and it's profitable and it's everything that I said it would do. So that's where I find myself the most. You said they're one of the biggest 401ks. They're one of the biggest wealth traps for the middle class. What do people not understand about them?
Yeah. So, it's kind of, we got a long answer for this one. So 401ks, IRAs, these so-called retirement vehicles, right? There are some things that are true for the masses about them. I'm going to point out some of the things just to kind of kick people's mindsets a little bit more neutral to think for themselves. Again, none of this is, financial or legal advice, but, the putting money away into these retirement plans, you defer the taxes on it. You're going to have to pay the taxes on it at some point. My first point here is most of the people going into these things, they think that when you get older, you're going to make less money. But most of us who are good savers and decent investors, you're going to increase your assets, increase your cash flow so that you're probably going to be making more money in the future than today, therefore being in a higher tax bracket. So point number one right there, wouldn't you want to just pay your damn taxes today than to pay whatever that rate is in the future? Similarly, point number two, the tax brackets probably are going to be going up. Now, this is a gamble, but I think most people would agree that government entitlement programs, Medicare, all this insurance stuff, it's probably going to be going up in inflation. So essentially by not paying your taxes today, you're giving the government a blank check to tax you at whatever the rate they want you in the future.
Yeah.
Third point, most people who get on the bandwagon of investing in alternative investments, paying less taxes, doing a little infinite banking in there to get to retirement, a decade or two before you're supposed to, right, at 60 or 70. If you put your money in those types of deferred retirement plans, you're probably going to have to keep it in there for another decade waiting for you, right?
Yeah.
It's kind of like shipping your suitcase out to where you are, but you can't get it at it yet. And the fourth reason also is around like tax benefits, right? Like when I invest in real estate, you get the depreciation from the real estate. When you go into larger deals, you can do things like cost segregations and extract bonus depreciation. Bonus depreciation is now at 100% now. And when you're doing this, you're able to get a lot more losses than you would need to offset the passive income in that investment. But if you're investing through a retirement plan, or some people are able to invest through self-directed IRAs, solo 401ks, even if you're able to do that to access alternative investments like real estate, those tax benefits are insulated in there. So it can't come back to help you today. And that's really the big point here is like, we want the tax benefits to help us today when we are growing our net worth, and really what's more important, because of the time value of money, right? If I save 10% in taxes today, that 10% that I would have not had otherwise, I think if I get it right in my head, that can grow and grow and grow and grow and grow, right? Yeah. So it's imperative that you try and shelter your taxes as much as you can early on, like today. And again, one of the ways of doing that is to not invest through one of these kind of plans and programs. And I say it all the time, right? Like a lot of my clients, some of the older ones in their 60s have kind of been duped in a way to invest in these 401k plans for decades, kind of do it the wrong way for that long. I do commend them, right? Because that's the hard way. That's a lot of grit doing that. But they get to a point, and a lot of people who do that are multiple six-figure earners because they apply themselves and they success in one place, and their finances also predicts success in their career, obviously. Sure. And they get to a point where they're in that highest tax bracket, like that $400,000 a year range. And if they get to the end there and they want to take money out of the retirement plan, they're going to be in that highest tax bracket. So they're like, shoot, I should have took this money out when I didn't make as much money in my 20s. So I think that was like 4 and maybe a bonus reasons in there. Again, none of this is tax or legal advice, but hopefully it just sets the stage right for people to like, maybe just let me think about this for myself. But in reality, if you're working a day job, you're not going to change your plans otherwise, because the problem, the chips are stacked against you, because everybody else around you, around the cubicle land, probably has these set of ideas, and they're going to think you're a weirdo for doing it. You really need to get around other investors. I mean, that's why I do like a retreat in Hawaii every year, and in a way, we kind of have the good group think going on, right? People understand and think things for themselves, and we get this echo chamber of ideas like that where you can kind of take it to the next level. But unfortunately, we are the 5 people we hang out with most. So if you don't have any accredited investor friends investing in these types of alternative investments and doing these alternative tax strategies, the chips are stacked against you, unfortunately.
Yeah, and you sound like the oddball, it's not the norm. It's not the norm whatsoever. Right. I understand. And so that you don't find, so somebody who's financially savvy, somebody who's wealthy, they're not maxing out 401ks. They're not parking money in the bank. They're using depreciation and cost seg, like you've mentioned, infinite banking and, K1 losses, all these terms. So all the things average people never hear about. So why don't rich people follow the same rules that, everyone else is sold?
Right. I mean, I don't know. I mean, sometimes I think to myself, like, well, why would people want to invest through a REIT where there's like 5 or 6 middlemen layers doing the 80 and the 2 and 20, right? The 2 and 20 is kind of, Google that, guys, like, or ChatGPT it these days. But that's essentially where the institutions strip away your profits and you take all the risks. Like, why would you allow somebody to do that multiple times on you? But that's what happens, right? Like, I mean, look at, I think it's Blackstone. Like, look at their super crypto ETF. All they freaking do is they just take a subset of Bitcoin and subset of Ethereum. It's not rocket science there, but then it's like their proprietary blend, like whatever. And now they're able to take 20% of your game. I don't know what the splits are in that fund, but it's like, I mean, but that's unfortunately how like the financial complex is done, right? And that was kind of where very early on I realized like, wait a minute, if I just buy a little rental property on my own, sure, I have a property manager in there, right? But that's well worth it, I think. Wow, I'm making some good returns doing this. And then I realized, oh shoot, if I just cut out all these other like certified financial planners selling me all the garbage, everybody's taking their cut. Wow, like I'm doing pretty well. And of course, now you got to think for yourself, right? Because you're getting off the beaten path. There is risk in that, right? Because some people out there are not able to, learn things, interact with people, network, right? But most people are. Can't say anything for Gen Zers or Gen A since they're somewhat socially recluse, and they're just going to go to blindly who has the prettiest app out there. But like I think if you get around the right people, you should be able to be confident in investing directly on your own and capture all the upside there. But hey, this isn't for everybody. This isn't for most people, right? If it was, then who would get our coffee? Who would build our bridges? Who would do the jobs out there that we wouldn't want to do for 50 years ourselves?
Exactly. Yeah. No, definitely wouldn't be the 1%. You've got a line. A lot of people stop and rewind when they hear it. Your spouse can stay home and you'll still net more after taxes. Can you explain that? Break that down?
Yeah, so in that one, what I'm referring to is a pretty common strategy that people in our ethos will do called the real estate professional status. This is a checkbox on your taxes. There's some, I don't want to get too much into the technicalities of it because I'm not a CPA. If people need a referral, they can reach out to me. But essentially what this is if you can demonstrate you're a risk professional, there are certain cool things you can take advantage of in the tax code where you can have one spouse, still work a day job like a doctor. Like this is a great use case. The doctor making a high income and then a stay-at-home spouse that manages some of their household rental properties. And now what that does, it essentially allows them to invest in real estate deals and get those surplus of passive losses to offset their income in their portfolio and possibly in their high W-2 or 1099 income. This is kind of a beautiful thing, right? Because, I like to kind of help people plan holistically in terms of like planning, right? Like I'm a young parent, right? It makes sense that you're able to stay at home and it makes sense you're able to stay at home with the kids and in reality, by implementing real estate professional status, which is just a checkbox on your taxes, you may save more taxes by doing this than both spouses working. Of course, talk to your CPA about it, but this is a beautiful thing, I think, and it just incentivizes investing more and more directly into these types of investments than to do it the traditional way, where the traditional way is made, for people to go to work and then the government hammers them with taxes, right? Because it's not coming from the wealthy people who are doing these types of strategies, or what I found people do the strategies, and it's certainly not coming from the poor people, right, who are getting the handouts.
No, of course not. Yeah, no,
it's coming from the shrinking middle class out there.
Yeah. Yeah, no, I agree 100%. So, when I was looking at this, it came up. So the wealthy, they don't just earn differently. They're actually taxed differently because they just understand it. Like when Trump, back when he was first running, they kept wanting to see his taxes, and it came out and he was like, they're like, well, he didn't really pay any taxes. And he was like, well, I'm just following the codes, so they just understand it, and I think that comes with the responsibility of building wealth is, you got to learn how to be able to keep it and not give it away, and how to work it. That's the whole thing with, make your money work for you instead of you work for your money. That's just another aspect of how I see it.
Yeah. Yeah. I'm not a huge fan of like tax loopholes or things like that, but the way I look at it is like the government has incentives for you to put your money in certain places, right? Like, for example, something that I do is like the government wants to get off of foreign reliance of oil, right? So we don't have to just kiss the butt of everybody in the Middle East all the time. And to do that, it makes sense for them to stimulate some US grown oil, which by the way, I think I'm in a deal in Oklahoma where you're at, but like, like that's, they want to incentivize that, right? For obvious reasons. So they will put things in the tax code to have little people like me invest in that type of stuff to get some nice tax benefits. So the key there is just like, figuring out like, okay, what is it, the incentives that they want? Right. I mean, maybe we do this with our own kids, right? Like, I'm like, if you want your iPad, you need to do this. Right. If my kid is dumb, they won't do it. Right. But, even kids, they follow these incentives. Yeah. And that's what I think all of us should be doing. Not from a facetious point of view, but like, this is what mom and dad want us to do. So we're going to do it. And like, this is the best way to that everybody comes out ahead, right? Like, I mean, the government wouldn't be putting this stuff out there unless they got some benefit. Now, of course, there's a lot of these like silly things out there that doesn't make a lot of sense, but hey, that's in any huge complex system. Right. But, I think like that the tax code is written in a way to incentivize behavior from people putting money in there. And, this is where like entrepreneurs and people who are investors, these are the people rightfully so paying, less taxes because they are putting their money where their mouth is and putting their money on the line for the places that the mom and dad want you to put it.
Exactly. Yeah. I used something like that. I sold a business. I'm originally from Detroit, and from Detroit, I moved out to Palm Springs, California. So I've been like on both sides of the coast. I went from the poor to the affluent, and now I find myself in the middle. But I had sold a business and I had some capital gains, and I invested in an opportunity zone. And to invest, because where Detroit was rebuilding, they wanted to stimulate and help more growth there. And so I took advantage of that and was able to defer some taxes by investing in an area that they wanted money to come in. They wanted the investments there, so they built up that area. And so, I took part in something like you were just explaining. So. Yeah. But didn't turn out the best for me. I didn't finish it. I ended up selling it. I ended up paying the capital gains anyways. And so it didn't turn out the way it should have, but that was the original intent. But it was one of those areas you talked about that they wanted to stimulate some influx of capital, some growth there. And I tried to take part of that. So, okay, let's rattle off some things just to get your feedback pretty quickly about some things. So let's hit some mistakes real quick. What's the biggest mistake first-time rental buyers make, in your opinion?
They don't run their numbers and include all the kind of the hidden costs, such as CapEx, insurance costs. So what you do there is, you can grab a spreadsheet, and I have one on my website. A lot of these are the same, but at least like you're able to think through every expense line item that comes up. If you don't know what these are, go on ChatGPT and say, what are all the possible expenses that are going to pop up, and create a fictitious P&L for me. Right? Like, and this is where you need to be conservative because, things will happen. Tenant will move out, they'll trash the property. You got to pay $5,000 here, $5,000 there. And that's where, like, on a month-to-month basis, you may seem like you're making $50, $100 every single month profit, but in reality, when one of these big ticket items comes up, you could be at a loss. So that just part of that comes from experience, I think, though, too.
I think one of the things that gets underestimated by people that's starting is is not taking into account the downtime when a tenant's out of there, the apartment's empty, you know, they're looking at their rent for the 12 months, but they're not counting that at least 1 month that you're not going to get anytime you're switching a renter. And sometimes it may be more. And I find people overlook that sometimes from my experience. So.
Yeah, you're typically going to run, I mean, tenants typically stay a couple years on average, but you know, there is that kind of time where it's in transition, right? So it's usually good to assume that you're going to run 5%, 10% economic vacancy every single year. And yeah, you know, we do that on the commercial side. You know, we never assume apartments, even if it's fully occupied, it's not 100%. It's usually at best 95 or 93%. Yeah. And then you're always going to have 3% of people in a good apartment not pay. They'll just be deadbeats. So that's kind of, you know, bad debt right there. So if your apartment has the ability to make $100,000, you're realistically only going to get 90 at best case. So, yeah.
I have one of my apartment buildings are almost entirely efficiency units. So I find turnover in there, you know, a little more frequently than I do some of my, you know, more established, you know, units, you know, larger units. But those efficiencies, they turn over a lot more frequently from what I find. Okay. So, and what's the biggest trap high earning W-2 people fall into?
Some of them don't realize they can do real estate professional status. I mean, this is where I kind of get on the phone with all my folks and we kind of just brainstorm different ideas. Some people are pretty close to making it all happen, especially if they have like a rental property nearby. So that, you know, they usually look at like the qualifications for that. I mean, they need to work with their CPA, but I think also another thing is like when people start working with me, I'd say like 80% of them change their CPA. The only reason why they don't, that comes up a lot, is like it's a family friend and they feel, you know, afraid for breaking that relationship. But, you know, a lot of these CPAs, you know, their job is to do the taxes, not really tax strategy. Sure.
Yeah, mine started outside of real estate with me. I don't know if his real estate is his prime profession. And so now that I am checked the box of a real estate professional, it's what I do 100% of the time. And I have these multifamily units. I don't know if the whole cost seg and everything is being used like it should be. You know, that's something that I have to look into for myself as well. So, all right. So you've said something like if you're still working a job and try to self-manage rentals, you didn't buy an asset, you bought another shift. Explain that mindset difference.
Well, I mean, nothing wrong with that too, right? I mean, again, at the end of the day, you look at an investment more from an equity multiple. Like what was your gain at the end of the day? I mean, this has kind of changed in my head. You know, initially I always wanted to see positive cash flow during the hold. I mean, who doesn't? But, you know, it's getting harder and harder to find that these days. And it is not the primary thing. The primary thing is, did you make money on it? I mean, for example, like, yeah, maybe you're making positive cash flow on it, but you sold it for 30 grand less than you bought it for. And at the end of the day, you lost money on the whole damn thing. Right?
Right.
So again, like I would look at things more holistically. I mean, certain parts of your portfolio, you want to have cash flow.
Right.
Like for example, some of my higher net worth clients, they'll do what's called closed-end funds. You know, these are traditional investments where they make a nice yield and they can get that cash flow. But essentially, all they're doing is they're making a gamble, or they're taking the early payout, right? But their money is not growing as fast as other parts of their portfolio. But that's the intention for that part of their asset allocation mix. Now, apparently I'm not a certified financial planner, so I can't really talk about asset allocation mix, but from what I see out there, there is no standard, you know, in the world of alternative investments. But it depends on what you're trying to go for, right? Like if you're taking 1 to 10% of your net worth and just wanted to just absolutely shoot for the moon, not worried about losing it, you know, that's where you may invest in a crazy altcoin. I personally wouldn't. But that's where you may want to invest in like a very disruptive venture capital tech investment. That's a very early stage, for example. there is no normal, but I think that these are kind of the vernacular and topics to be able to talk to other purely passive accredited investors and kind of get a sense of what you're trying to do with your asset allocation mix.
Mm-hmm. No, I agree.
You can't just be like, oh, we're just finding good deals. You know, that's silly. You know, it's just like drafting a fantasy or football team. It's like we're just picking the best player that's available. It's like, no, that's not what you do. You need to fill out your positions, dude. Like that's how you play.
Yeah, 100%. So before we get out of here, let's just mention the book one more time. The Wealth Elevator. Who's it for, and what are they going to get from it?
Yeah, it's the Wealth Elevator found on Amazon. It is mainly for people who are growing their net worth, not quite like need basic stuff. It's not a Dave Ramsey, Caesar Orman, or Rich Dad Poor Dad book written for the masses. It's mainly for people who are going to become accredited investors pretty shortly, and obviously ascend up second, third, fourth of the Wealth Elevator quickly. If people buy it and they shoot us a screenshot, team at thewealthelevator.com, we'll hook them up with the free PDF and then the MP3s as a thank you. If people are an accredited investor, they can reach out to me personally, Lane at thewealthelevator.com. But yeah, thanks for having me, David. Appreciate it.
You're very welcome. You're very welcome. So any last words? You've told everyone where to find the book. Are we, that was the last plug that, direction for the book?
Yeah, if you're a no money millionaire and you have less than $250,000 net worth, just know that's the toughest place to be, right? That's the hardest part. And yeah, don't pay anybody more than $5,000, $10,000 for education that you can find it online.
Yeah, there's a lot of that out there these days. And I'll make sure that I put your link. It's thewealthelevator.com. I'll make sure I post your link in the description of the podcast as well, so people can find you from there. So, Lane, it was great to have you on. I appreciate your time. It was very informative. Thank you.
Yeah. Cool. Thanks, David.